Hello, I'm Philip Atkinson. I lead the Mergers and Acquisitions service line here at Wilson Partners. I'm joined today by Tom Bradbury, who leads the Transaction Service Advisory line, and Dan Davies, who's a manager in his team. I'll hand over to Tom and Dan to introduce themselves.
Thanks, Philip. Yes, my name's Tom. I've been working in Wilson Partners in transaction services for just over 6 years now, and in previous roles kind of around the transaction services community for just under 10 years.
Hi Philip, I'm Dan. So been working in transactions for 6 years across tax and finance side, working closely with Tom now and the team.
Thanks, Tom and Dan. Most business people are familiar with audits and all the accounts review that I have every year, but they probably haven't come across due diligence. What is due diligence and how does it differ from an audit?
Sure. So if I'm talking now in the context of transaction services and the kind of M&A transaction environment, let's say we've got a buyer, so that can be a corporate, private equity firm or an individual, and they're looking to acquire or invest in an asset. Let's say that's the acquisition of a trading company. Before they complete on that transaction, they want certain assurances themselves. They want to be comfortable that what they're buying is what they expected it to be, that it's going to deliver what they expected it to deliver for them. There's no hidden risks or liabilities that might be inherited on purchase, and importantly, what they're paying for that company is a fair and reasonable price. So the process that a buyer would engage in to get those certain assurances is what we call due diligence. Essentially, it's a pretty comprehensive assessment of the company in question, and is performed across a number of streams. So we've got legal due diligence, financial tax due diligence, commercial due diligence, technological due diligence, environmental, and the list can go on depending on the buyer's kind of requirements. Here at Wilson Partners, we perform financial and tax due diligence services for our clients, which, as the name suggests, is focused around the numbers, around the finances and the tax, and it really kind of focuses around the last 1, 2, 3, 4 years of trading of that company, really getting under the skin of the numbers, understanding how that company's been trading, what its true profitability is, and then the insights we gain from that can inform our views on the forecasts they're presenting. Do they seem reasonable? Are they achievable? And also, as I mentioned earlier, the price that the buyer is looking to pay, is that fair? Now, you mentioned about the audit, so I guess in terms of a comparison, I think the purpose and the audience of an audit and a due diligence are fundamentally very different. So as I've just discussed, the due diligence is primarily for the purposes of the buyer to get to attain some assurances and comfort that what they're buying is what they expect. And as such, the scope and what we do will be led to an extent by that buyer, what they want to see, what they want to find out. An audit, on the other hand, is an annual process focused very much or almost predominantly on the last set of accounts. And that is really there to provide assurance on those accounts to a wider group of stakeholders, be that employees, customers, suppliers, capital markets, really users of the financial statements. So with that in mind, there's more regulation around audit, and I suppose the audit approach is a bit more prescribed, and traditionally probably more testing is involved in an audit than a DD.
You mentioned there the people that would rely on an audit report being fairly extensive. What about a due diligence report? Is the people that can rely on that report limited, and how do you manage that process?
Yeah, so it's not just the buyer, but what I would say is it's certainly more focused. You know, if we're going back to the audit comparison, with an audit, those accounts are publicly available to anyone. You know, you have your kind of key stakeholders that you know will use them, but fundamentally it's out there. With a DD, we engage with our client, which is typically the buyer. Not always, but I won't get into that right now. However, down the line, various other interested parties in that transaction will want reliance, or at least non-reliance, to look at that report, such as banks, if banks are getting involved in lending money as part of the transaction, the advisors, the lawyers, the other streams of DD. I mentioned there's various other streams of DD will probably want to be looking at that report and drawing their conclusions and their findings from it. The way we manage that is, as I say, we initially engage with the client, who is primarily the buyer, and down the line we will engage on a separate basis with anyone who needs reliance on our report. As I say, that's typically banks for whom the buyer are looking to bring in to fund the transaction.
And you mentioned there that the purpose of due diligence is largely to be confirmatory and support the valuation decisions and models that, probably for an offer that's already been submitted to enable the process to advance to that due diligence stage. So what you mentioned, different types of due diligence in terms of legal and commercial and things like that. But what about financial due diligence? There's different types of financial due diligence. Do you want to give some advice on that? What are the different types of financial due diligence that you see?
So it depends really what side of a transaction you're on. So from sell side, you can see vendor assist, which is essentially you're getting a company's finances in a position where they're able to be analysed easily as part of a transaction, because obviously a company may be doing financial reporting on a month-to-month basis, but it may not be perfect if a bidder comes in for them to essentially analyse the business quickly. In a transaction, you want things to work smoothly, so if the information's in a good position, then it helps all parties. Also, vendor due diligence, it's more of a report form, so essentially what we'll be looking to flag any potential risks that we see with the target. Essentially what you're doing there, and it's helpful for a seller, is if you can flag potential areas that the buyer may pick up later on in the part, you can get ahead of it. And it's also the case that you can also highlight positives about the business, especially if you're looking at potential bidders. There's several. It can be far more helpful, and it means when they do come to purchase the business, it's more top-up buy-side DD than it actually would have to be if that wasn't the case.
Top up, yeah. So top up on VDD. I mean, I suppose the other side of the fence there is if we've been engaged by a buyer who's approaching a sale that has some vendor due diligence already prepared, not by us, we would then come in, review that vendor due diligence report, and assess any gaps we feel exist or any top up that might be required based on time elapsed since the VDD report. And we would would then engage with the buyer to perform essentially a top-up piece of DD, which, back to my earlier point, is just would be a very tailored and kind of focused piece of work for that buyer.
So you've mentioned the scope. What are the key issues that you focus on when you're undertaking a due diligence exercise?
Yeah, so I think primarily, and as I said when I started at the top, the key issues are: is the buyer buying what they're expecting that they're buying? So what does that mean? I suppose that means the profitability of the company. So we'll really dig into the profitabilities. We'll look at any exceptional events or exceptional incomes or exceptional costs that may have transpired during our review period. We'll strip those out as appropriate, and we'll really be kind of presenting that underlying profitability of the company, which, as I say, hopefully stacks up with the expectations of the buyer. That has a secondary kind of effect in that once we've got to that level of underlying profitability, that directly then impacts how valid and how fair we feel like the agreed price is. So one thing I don't think I mentioned at the top, but the due diligence process, this is buyer-led due diligence. Vendor due diligence happens earlier on, but the buyer-led due diligence process will typically occur probably towards the end of the overall sale process, by which point you've already got signed terms, you've already got agreements of price. There's a lot of things, I won't say set in stone, because that's the point of the due diligence, but already set. So we're looking at profitabilities, we're looking at things like that to verify or lead to negotiations on those numbers. I think the other part, so that's very much trading, is which is maybe more compliance and a bit not simpler, that's not the right word, but a bit more compliance focused is, does the company and does the target come with any hidden risks or liabilities that may not be obvious, but then transpire post-transaction. That's very much focused as around us reviewing balance sheets, our tax team reviewing tax liabilities, and any hidden things that might transpire from the entities in that regard.
Yeah, and I suppose it depends on the complexity of the transaction and how the price has been struck. But obviously, heads and the commercial terms have probably been summarised already. But then you're looking at areas which haven't yet been negotiated and discussed, and that would be things like normalised working capital, as you say, the quality of earnings. Are they selling off the back of a normal profitability or something like that? So looking to adjust there, looking at things like run rates and so forth to support that acquisition decision. Obviously, we live in a time that rapidly changing trends and things like that. Are there any emerging trends in due diligence that you've been asked to look at? Perhaps areas that you hadn't historically had to look at, such as ESG or something like that?
Yeah, I mean, we've mentioned it a couple of times now, but I think one of the trends that I've seen working in due diligence probably over the past 18, 24 months is an increasing request for vendor due diligence services for our, in that case, would be our clients who are the sellers in that case. I think in the former part, I suppose to put that into context, the majority of transactions that we perform at Wilson Partners probably have an overall deal value of, let's say, 10 to 60, 70 million. I think when we're going higher than that, vendor due diligence is clearly a more regular and practiced concept. In the space that we tend to work in, as I say, particularly around the former part of my career, it was largely buy-side or buyer-led DD, and sellers wouldn't really see the cost benefit of putting money into a vendor due diligence product at the forefront. As I say, over the past 18, 24, maybe a bit more months, we've been engaged and we've performed a lot more vendor due diligence than, comparatively we have in that prior period. I think, coming back to what we said about vendor due diligence earlier, that is probably just a reflection of risk appetites in the kind of current climates. It really puts the seller on that front foot. They've identified any risks that may come out. They kind of know what position they're in ahead of going to market. And fundamentally, it significantly reduces our transaction risk. We see, lots of deals. That buyer-led due diligence process can be a relatively risky time in terms of deals failing. And if you've got a vendor due diligence product that sets out, as Dan said, kind of your risks, your opportunities, the whole company, the buyer just needs to do some top up. And it's just, I guess the name of the game is making it as easy as possible for the buyer to complete their diligence process.
And as we know, time is an enemy to deals to a certain extent, and if it's going to shorten timelines and enable the deal to happen quicker, it's got to be a good thing.
Yeah.
What are the key differentiators between Wilson Partners' due diligence offering and perhaps other firms that are operating in the same sort of SME space?
Sure. I mean, first and foremost, I've got utmost confidence that our team is providing the highest quality advice and analysis to our clients, and I will always believe that that's a differentiator for us. Outside of the, I suppose, more technical piece like that, I think the key differentiator for us as a team is the way we approach our collaboration and working with our clients. So we, from the outset, we very much see ourselves as an extension of our client's team. We don't see ourselves as external advisors who turn up, gather information, then provide a report at the end of the process. We will be doing as much as we can to help and take and support and lift any loads that our client might need during that whole due diligence process. I think the key way that we do that is through sharing all of our analysis and calculations and findings with our clients on a kind of real-time basis throughout the process. We call that our data book, which is essentially just the central repository of all our work. And yeah, we share that with our client throughout the process, which our clients really value because they can review our work, they can take insights from our work, they can use our work because more often than not, our client is simultaneously doing their own desktop research and preparing their own papers. And to have our work just to review and then lift and put in is very helpful for them. So I think that process of kind of continuous and continual information sharing throughout the process, I think sets us apart. You know, the tagline or the plan is always that, yes, we will produce a report, which we are equally proud of at the end of the process, but that report shouldn't have anything in it that we haven't already talked about with our client and gone through in lots of detail. So the final product can be almost confirmatory of the whole process that we've gone through with them.
But that's due diligence. When it's done well, it's sort of a discussion with the client. The client will know the key areas they'll want to look into before the transaction starts. And if we can have that transparent and open sort of method, then it can only help a good DD process throughout.
Thank you, Dan and Tom, for the insights on due diligence.